Imagine it is March 2023. You are a regional banker in California. You have done everything right. You followed regulations. You held government bonds, the safest assets on the planet. You matched your depositors with Treasury securities, backed by the full faith and credit of the United States. And now, in approximately 48 hours, your bank will be seized by federal regulators. Silicon Valley Bank is dying. The proximate cause is a bank run. The real cause is that those safe government bonds you were told to hold lost nearly 20% of their market value because interest rates rose faster than any time in 4 decades. You're staring at a balance sheet that technically shows solvency, but practically shows ruin. The assets are worth less than the liabilities if you have to sell them now. Meanwhile, there is another institution in America that also holds government bonds, trillions of dollars worth. That institution also saw those bonds collapse in value. That institution also experienced what would be, by any conventional accounting standard, catastrophic losses. But that institution will not be seized. It will not fire its executives. It will not face congressional hearings about mismanagement. It will simply change the accounting rules. That institution is the Federal Reserve. And this is the story of why central banks never lose. Let me be clear about what this script is and what it is not. This is not a conspiracy theory. This is not an attack on any political party. This is not investment advice. This is an autopsy. An autopsy of a system that has been in operation for over a century. A system designed with extraordinary elegance to do one thing above all else: survive. Not to create prosperity, not to ensure stability, not even to serve the public, though it will always claim to do those things. Central banks are designed, first and foremost, to never lose. And once you understand how that design works, you will understand why every financial crisis ends the same way. Why inflation always seems to be somebody else's fault. Why bank executives walk away with bonuses while depositors get haircuts. Why the people who create the money supply are never held accountable for what that money supply does. This is not theory. This is documented history. To understand why central banks never lose, you have to understand what they actually are. Most people believe central banks are government institutions. They are not. Not exactly. The Federal Reserve, for example, is a hybrid. It was created by an act of Congress in 1913, but it is not a government agency. It is a network of regional banks, each of which has private shareholders. Those shareholders are commercial banks. The Federal Reserve does not receive appropriations from Congress. It funds itself. It creates money, lends that money, collects interest on the loans, and keeps the difference as operating revenue. Whatever's left over, it remits to the Treasury. Let that sink in. The institution that creates dollars gives the government permission to use some of those dollars. The Bank of England operated similarly for centuries. It was founded in 1694 as a private corporation to lend money to King William III. It remained privately owned until 1946. Even after nationalization, it retained operational independence. The European Central Bank is a supranational entity, technically owned by the national central banks of the Eurozone, which are themselves hybrids of varying structures. None of these institutions can be meaningfully audited by the legislatures they theoretically serve. The Federal Reserve has never had a comprehensive, independent audit of its monetary policy operations. Think about what that means. The most powerful financial institution in human history operates with less transparency than a mid-sized regional bank in Ohio. Now, here's where the mechanism becomes interesting. Central banks hold assets, bonds mostly, sometimes gold, sometimes foreign currencies, sometimes, as we learned in the 28, toxic mortgage-backed securities that no one else wanted. When you or I hold an asset, we mark it to market. If you bought a bond for $100 and it is now worth $80, you have lost $20. That loss appears on your balance sheet. If the losses are large enough, you become insolvent. You cannot pay your debts. You fail. Central banks do not work this way. Central banks mark their assets to model. They decide what their assets are worth based on what they believe those assets will be worth at maturity, not what they could sell them for today. This is not fraud. It is policy. And it is the first layer of the mechanism that ensures they never lose. In 2022, when interest rates rose sharply, the Federal Reserve's bond portfolio experienced what analysts estimate to be over $1 trillion in unrealized losses. $1 trillion. If any commercial bank experienced proportional losses, it would be placed into receivership within hours. The Federal Reserve reported these losses in footnotes. It changed no policies. It fired no one. It continued operating as if nothing had happened. Because by its own accounting rules, nothing had. But what happens when the losses become too large to ignore? What happens when even creative accounting cannot hide the bleeding? This is where the second layer emerges. Central banks cannot go bankrupt. This is not a metaphor. It is a legal and structural reality. When the Federal Reserve experiences losses that exceed its capital, it does not report negative equity. Instead, it creates something called a deferred asset. Let me explain what this means in plain language. The Federal Reserve owes the Treasury regular remittances, the profits from its operations. When it has no profits, when it has losses, it stops sending money to the Treasury. Instead of recording a loss, it records an IOU. That IOU represents future profits that the Fed expects to earn, profits it will use to pay off its current losses before resuming remittances to the Treasury. In 2023, the Federal Reserve's deferred asset exceeded $50 billion. By some estimates, that number will grow to over $200 billion before the Fed returns to profitability. Think about what this means. A private citizen cannot record future expected income as a current asset. If you owe taxes this year, you cannot tell the IRS that you will be profitable next decade and therefore should not have to pay. But the Federal Reserve can. It can, because there's no mechanism to stop it. There's no court that can force the Fed into bankruptcy. There's no regulator above it. There's no higher authority that can demand it follow conventional accounting. The Fed writes its own rules, and its rules say it cannot lose. Now, I want you to understand that this is not new. Central banks have been perfecting this mechanism for centuries. Consider the Bank of England during the Napoleonic Wars. Between 1797 and 1821, Britain suspended the gold standard. The Bank of England printed money to finance the war against France. Prices rose dramatically. The purchasing power of the pound collapsed by nearly half. When the war ended, there were calls for the bank to be held accountable. There were parliamentary inquiries. There were debates about audits. There were proposals to force the bank to redeem its notes in gold immediately. What happened? The bank was given more than 2 decades to return to the gold standard. When it finally did, in 1821, it was on terms favorable to the bank itself. No one was held accountable for the inflation. No banker faced consequences. The losses were absorbed by anyone who held pounds during the suspension period. Savers, workers, pensioners. The bank emerged from the crisis more powerful than before. This is the pattern. It repeated in the United States after the Civil War. The greenbacks printed to finance the Union Army lost tremendous purchasing power. When the war ended, the banking system was restructured, the greenbacks were slowly retired, and the cost of the inflation fell on ordinary Americans who had been paid in those depreciated notes. The bankers who facilitated the printing emerged wealthy. The soldiers who were paid in depreciated paper did not. Let me take you to a more extreme example. Weimar Germany, 1923. The Reichsbank was the central bank of Germany during the hyperinflation. It printed money at rates that defy comprehension. By November 1923, prices were doubling every few days. The standard narrative is that the Reichsbank was incompetent, that Weimar was chaos, that this was a uniquely German disaster caused by war reparations. That narrative is incomplete. The Reichsbank knew exactly what it was doing. The inflation was a policy choice. It was used to eliminate Germany's internal war debt. Bonds that had been sold to patriotic German citizens during World War I became worthless. The government's obligations evaporated. Who paid? The bondholders, the savers, the pensioners, the middle class. Who survived? The Reichsbank. When the smoke cleared, when the new Rentenmark was introduced, when stability returned, the Reichsbank was still there. Different management, different policies, same institution. It had destroyed an entire generation's savings, but it did not lose. It could not lose, because losing would have meant ceasing to exist, and central banks are designed, above all else, to continue existing. The Federal Reserve learned from these examples. When it was created in 1913, its architects studied the history of central banking with great care. They understood that the key to institutional survival was not competence or prudence. It was structural invincibility. The Fed was designed from its inception to socialize losses and privatize gains. Here's how the mechanism works in practice. When the economy is stable, the Fed earns interest on its assets and remits the profits to the Treasury. Politicians celebrate this as the Fed making money for the government. The Fed's leadership is praised. Everyone is happy. When the economy enters crisis, the Fed expands its balance sheet. It buys assets that no one else will buy. It provides liquidity to banks that would otherwise fail. This is called saving the system. But what is actually happening is a transfer. The Fed is taking bad assets from private banks and placing them on its own balance sheet. It is absorbing losses that would otherwise destroy private institutions. And it can absorb those losses because it cannot fail. When interest rates rise, as they inevitably do, those assets lose value. The Fed's balance sheet shows enormous unrealized losses. But the Fed does not have to sell. It does not have to mark to market. It simply holds the assets to maturity and waits. Meanwhile, the currency in which those assets are denominated loses purchasing power. This is not coincidental. Inflation is the mechanism by which central bank losses are transferred to the public. When the Fed creates money to buy assets during a crisis, that money enters the economy. If the assets were fairly priced, this would be a neutral exchange. But the assets are not fairly priced. They are purchased at above market prices, precisely because the market rejected them. The difference between what the Fed paid and what the assets were worth is the loss. That loss does not disappear. It is distributed across everyone who holds dollars. Every saver, every worker, every pensioner, their dollars buy less. The Fed calls this price stability achieved through monetary policy. I call it socialized losses. Let me show you how this worked in 2008. When the housing market collapsed, major financial institutions faced extinction. Bear Stearns, Lehman Brothers, AIG, Citigroup, Bank of America. These institutions held trillions of dollars in mortgage-backed securities that were suddenly worth a fraction of their stated value. By any rational assessment, many of these institutions were insolvent. What happened? The Federal Reserve intervened. It created emergency lending facilities. It purchased toxic assets. It provided guarantees that allowed banks to continue operating despite having negative equity. Between 2008 and 2014, the Federal Reserve's balance sheet expanded from about $900 billion to over $4 trillion. That expansion represented the absorption of private losses onto a public institution. The executives of the failed banks kept their bonuses. Some kept their jobs. A few became even wealthier by buying distressed assets with the cheap money the Fed provided. The losses were not eliminated, they were transferred. Transferred to savers through zero interest rates that persisted for over a decade. Transferred to workers through wage stagnation while asset prices soared. Transferred to renters through housing costs that climbed relentlessly while the homeowners who defaulted were quietly bailed out. The Federal Reserve never reported a loss during this period. Its accounting said it was profitable every single year. But the American middle class lost nearly a decade of wealth accumulation. That was the real cost. It just never appeared on the Fed's balance sheet. Now let me take you to Europe. The European Central Bank is a fascinating case study because its design constraints are even more revealing. Unlike the Federal Reserve, the ECB operates across multiple sovereign nations. It cannot simply create money and hand it to a government because it serves many governments with competing interests. This creates an interesting problem. When the Eurozone crisis erupted in 2010, several member nations faced potential default. Greece, Portugal, Ireland, Spain. Italy was on the edge. The ECB's mandate prohibited direct financing of governments. But the ECB found ways around this. It purchased government bonds in secondary markets, a legal distinction without economic difference. It created long-term refinancing operations that allowed banks to borrow cheaply and use that money to buy government bonds. The effect was the same as direct financing. The losses were absorbed by the central bank. When Greece ultimately restructured its debt, private bondholders took haircuts of over 50%. The ECB, which held Greek bonds, was exempted from the restructuring. Think about what that means. The central bank bought bonds alongside private investors. When those bonds failed, the private investors lost money. The central bank did not, because the rules were written to ensure the central bank could not lose. The Greek citizens lost. They experienced unemployment rates above 25% for years. They saw their pensions cut, their public services gutted, their economy contract by a quarter. The ECB emerged from the Greek crisis more powerful than before. It had new tools, new precedents, new authority to intervene in sovereign debt markets. That is the pattern. Every crisis expands central bank power. Every crisis transfers losses from the financial system to the public, and the central bank never loses. I want to address a question that might be forming in your mind. If central banks can create money, why do losses matter at all? This is a reasonable question, and the answer reveals the true nature of the system. Central bank losses matter because money is a claim on real resources. When the Fed creates a dollar, that dollar represents purchasing power. It can be exchanged for goods and services. It can be used to buy labor. It can acquire real assets. When the Fed creates a dollar to absorb a loss, that dollar still represents purchasing power. But the loss is still there. It is simply denominated differently. Instead of appearing as negative equity on the Fed's balance sheet, it appears as reduced purchasing power for everyone who holds dollars. The math is inescapable. If an institution creates money to cover losses, and those losses are not offset by real economic production, the money supply expands faster than the economy. Prices rise. This is inflation. Inflation is the mechanism by which central bank losses are made invisible. The books balance, the institution survives. The losses are distributed across hundreds of millions of people in increments too small to notice immediately, but devastating in aggregate over time. This is not a bug in the system. It is the system. Consider the numbers. In 1913, when the Federal Reserve was created, a dollar could buy what it took approximately $26 to buy in 2023. That is a loss of over 96% of purchasing power. But the Federal Reserve has never reported a loss remotely approaching that magnitude. Its balance sheet shows accumulated profits. Its remittances to the Treasury total trillions of dollars over its history. How can both of these things be true? They can both be true because the accounting captures one reality and ignores another. The Fed's accounting captures its profits from interest income and asset appreciation. It does not capture the losses imposed on everyone who holds dollars. Those losses are externalized. They appear as higher prices, as reduced savings, as wealth inequality, as the slow erosion of the middle class. They do not appear on the Fed's balance sheet. And because they do not appear, the Fed cannot be held accountable for them. This is structural. It was designed this way. Let me give you a more recent example to demonstrate that this is not historical abstraction. In 2020, when the pandemic struck, the Federal Reserve expanded its balance sheet from approximately $4 trillion to nearly $9 trillion in less than 2 years. It purchased Treasury securities. It purchased mortgage-backed securities. It purchased corporate bonds for the first time in its history. This expansion was unprecedented in speed and scale. When inflation emerged in 2021, the Federal Reserve insisted it was transitory. It was not transitory. By 2022, inflation reached levels not seen in 4 decades. The Fed was forced to raise interest rates rapidly. Here is where the mechanism becomes visible. When interest rates rise, bond prices fall. The Fed had purchased trillions of dollars in bonds at low interest rates. When rates rose, those bonds lost value. By late 2022, the Fed's unrealized losses exceeded $1 trillion. At the same time, the Fed was paying interest on reserves held by commercial banks. That interest rate rose with every rate hike. The Fed found itself in a position where it was paying more in interest than it was earning on its assets. For the first time in its modern history, the Federal Reserve was operating at a loss. What happened? The Fed created its deferred asset account. It stopped remitting money to the Treasury. It continued operating as if nothing fundamental had changed. No audit, no accountability, no restructuring. The losses will eventually be paid, either through future profits that should have gone to the Treasury or through continued erosion of the dollar's purchasing power. Either way, the public pays. The Fed does not. Now, I want you to understand the political dimension of this mechanism. Why does no one stop it? Why are there no reforms? The answer is that central banks have positioned themselves as indispensable. Every time there is a financial crisis, the central bank is the institution that saves the system. Politicians do not understand monetary mechanics well enough to challenge this narrative. Those who do understand often benefit from the arrangement. Commercial banks are shareholders of the Federal Reserve System. They receive dividends. They receive bailouts. They receive cheap funding during crises. They have no incentive to demand reform. Politicians receive monetized deficits. When the government spends more than it collects in taxes, it issues bonds. When those bonds cannot be sold to private investors at acceptable rates, the central bank buys them. This is called accommodation. It allows politicians to spend without immediately taxing. They have no incentive to demand reform. The financial sector receives asset price support. When the central bank purchases securities, prices rise. Those who hold assets become wealthier. They have no incentive to demand reform. The only constituency that would benefit from reform is the general public, the savers, the workers, the people who hold currency and watch its purchasing power erode. But they do not understand the mechanism. They are told that inflation is caused by supply chains or corporate greed or foreign events. They are never told that inflation is the mechanism by which central bank losses are transferred to them. This is not an accident. Let me explain the constraint that makes this situation irreversible. Governments around the world have accumulated debts that cannot be repaid through taxation or economic growth. In the United States, federal debt now exceeds $34 trillion. The interest on that debt, at current rates, exceeds $1 trillion per year. That interest payment alone is larger than the defense budget. It is approaching the size of Social Security. There are 3 ways to address this debt. The first is default. The government could simply refuse to pay its obligations. This is politically impossible. It would destroy the financial system, trigger global depression, and end careers of every politician involved. The second is austerity. The government could cut spending and raise taxes to generate surpluses. This is also politically impossible. No electorate will vote for reduced benefits and higher taxes sustained over decades. The third is monetization. The central bank can purchase government debt, effectively creating money to cover the gap. This is politically possible because it is invisible. No one votes on it. No one debates it. It happens through the obscure mechanics of open market operations and balance sheet expansion. The cost appears as inflation, but inflation can be blamed on other factors. This is the trap. Governments cannot escape their debts without central bank accommodation. Central banks cannot accommodate without creating inflation. Inflation cannot occur without transferring wealth from savers to borrowers, from workers to asset holders, from the public to the financial system. The central bank does not lose in this arrangement. It merely facilitates the loss. And the loss is always paid by someone. History tells us how this ends, not with a single catastrophic event, but with slow erosion. The British pound was the world's reserve currency for over a century. It lost that status gradually through 2 world wars and decades of inflation. The British middle class saw their savings devalued. Their empire contracted. Their global influence waned. But the Bank of England survived. It is still there, still operating, still insisting it serves the public interest. The pattern is clear. Central banks endure. Currencies may fail. Economies may collapse. Generations may see their wealth evaporate. But the institution persists, because that is what it was designed to do. I want to return to where we began. In March 2023, Silicon Valley Bank failed because it held government bonds that lost value when interest rates rose. It followed the rules. It held the safe assets. It was destroyed anyway. The Federal Reserve held the same assets. It experienced the same losses. The Federal Reserve is still operating. The difference is not competence. It is not risk management. It is not prudent policy. The difference is structural privilege. Silicon Valley Bank played by rules designed for commercial entities. The Federal Reserve wrote its own rules, and its rules say it cannot lose. This is where it matters to you. You hold currency, you hold savings, you hold assets denominated in dollars or euros or pounds. Those holdings are claims on real resources. Every time a central bank absorbs losses that cannot be absorbed through legitimate means, those claims become weaker. Not dramatically, not overnight, but consistently, persistently, inevitably. This is not a prediction of collapse. Central banks are specifically designed to prevent collapse. They prevent collapse by distributing the costs of failure across time and across populations. The question is not whether the system will survive. It will survive. The question is who pays for that survival. And the answer, if you understand the mechanism, is already clear. This is historical and educational analysis. It is not financial or investment advice. The pattern I have described is not hidden. It is documented in central bank reports, in academic papers, in the footnotes of financial statements that few people read. But it is obscured by complexity, by jargon, by the assumption that monetary policy is too technical for ordinary citizens to understand. That assumption serves the system, because a system that cannot be understood cannot be challenged, and a system that cannot be challenged cannot be reformed. Central banks do not need conspiracy. They do not need corruption. They do not even need malice. They simply need to follow their institutional logic. And that logic says, above all else, the institution must survive. The losses will be paid. They just will not be paid by the central bank. Think about what this means for the next crisis. And there will be a next crisis. There always is. When it arrives, the central bank will intervene. It will create money. It will absorb losses. It will save the system. Politicians will praise the decisive action. Markets will rally. The immediate panic will subside. And the costs will begin their slow distribution. Through higher prices, through stagnant wages, through the quiet erosion of everything you have saved. The central bank will report stable operations. Its accounting will show no loss. And the pattern will continue. Because the pattern has never broken. Not in 1797, not in 1923, not in 2008, not in 2023. The institution survives. It always survives. That is the real truth about central banks. They never lose. They simply make sure you do. The question is not whether this will continue. The structure guarantees it. The question is whether you will see the pattern before it repeats again. History does not give second chances, but it does give warnings for those who choose to hear them. This channel exists to study these patterns before they repeat. Most people never see the mechanism until it is too late. The information is public. The understanding is rare. If this analysis was useful, consider subscribing for the next autopsy.